more and more attributes, gotta love them. Now, when a corporation acquires property, it could be through purchasing property. The property could be contributed by shareholders or other means. This property then becomes an asset of the corporation. So that's something to know. You might have picked up on that, but why are we explicitly stating this? It's because we don't want you to think that, well, it's still the shareholder's asset. Let's say I buy into a company and I contribute my farm to the company. Well, that farm now belongs to the corporation. Even though I'm a shareholder and I own part of the corporation, I don't own a percentage of the farm. I own a percentage of the corporation that owns the farm. So making sure we understand how that works. And then we've got no gain or loss by the corporation when property is contributed. As we said, when a shareholder contributes property, the corporation generally is not going to recognize gain or loss. If you see things that pop up multiple times, say it with me, it's important. So make sure you know that, and then we can apply that to many numerical examples. Let's see, we've got some examples here. For the first off, we've got ABC Corporation that acquires a piece of land to build a new office. The corporation purchases the land for $500,000 in cash. In this case, the land becomes an asset of ABC Corp with a cost basis of $500,000. That one's pretty straightforward, nice there. Now, what about the other example we've got? Imagine that John, who is a shareholder of XYZ Corp, contributes a piece of equipment to the corporation. The equipment has a fair market value of $200,000 and a tax basis of $150,000. In exchange for the equipment, John receives additional shares of XYZ Corp worth $200,000. Now, when XYZ Corp receives the equipment, it does not recognize a gain or loss in the transaction. The corporation's basis in the contributed equipment is the same as John's basis, which is $150,000. In this example, John does not recognize a gain on the exchange because he received only stock in the transaction and the 80% control requirement is met, assuming John and the other contributing shareholders maintain at least 80% control after the transfer. That's just to prevent it dealing with any mergers, acquisitions. And because it doesn't say anything about that, we can assume it. Now, this is my example. If this was the exam, they'd be a little more clear about it and they would mention what level of control there was. Next up, some even more dealing with our initial lesson on the corporations. What do we need to know here? Well, the corporation basis in property is the greater of the net book value or debt assumed. This is the first time we're starting to talk about what happens if there's a liability or debt associated with the asset that's contributed. Well, the corporation's basis in the property acquired is the greater of the property's net book value or the debt assumed by the corporation in the transaction. We're going to see an example quite soon after this, and that is going to be where, let's say you've got a house or a building contributed to the corporation, but it's got a mortgage on it. Pretty common situation. We'll see how we deal with that. Then next up, shareholder gain or loss. Shareholders may recognize gain or loss in the exchange of property for stock, depending on the transaction's circumstances. We want to make sure we see as many examples of those as possible. Hey, maybe I'll record an extra 3-hour video of just extra examples. Nah, just kidding. Giving you the best examples we can here during this lesson. Diving into our examples here. First off, for our first one, we've got a corporation basis in property greater of net book value or debt assumed. And as promised, we've got in this case, commercial building that is going to have a mortgage that's a liability. So DEF Corporation acquires a commercial building from Jane, a shareholder, in exchange for additional shares of the corporation. The building has a net book value of $400,000 and a mortgage of $450,000, which the company is going to assume. They're taking on the mortgage as well. Now, in this case, interesting. It looks like the mortgage is a lot greater of a value than the net book value of the asset. In this case, the corporation's basis in the property acquired is going to be the greater of the net book value or the debt assumed. And in this case, since simple math dictates that $450,000 is greater than $400,000, we are going to see that the debt assumed is greater, and as such, the corporation's basis is going to be $450,000. Next up for the shareholder gain or loss, let's assume that Jane's tax basis in the commercial building is $350,000. She exchanges the building with a mortgage of $450,000 for additional shares of DEF worth $450,000. Now, Jane's gain in this transaction can be calculated as the following. We've got the amount realized, which is the total value of the shares received of $450,000. What was the tax basis in the property? It's given to us, it's $350,000. So the gain here is going to be the amount realized minus the tax basis. $450,000 minus $350,000 giving us $100,000. In this case, Jane is going to recognize a gain of $100,000 on the exchange of the property for stock. However, if the transaction meets the requirements for non-recognition of gain or loss, such as Jane and the other shareholders maintaining at least 80% control after the transfer, Jane receives only stock in the transaction. She may defer the gain, and it will not be taxed until she sells the shares. Now, again, all of these examples, they're not really telling us that, but we're focusing in on the other parts of what we're seeing here. So yeah, if this question said that there was 80% control, then there would be no gain recognized, because what is gain recognized? It's what's actually recorded on the tax return. However, it doesn't say, so let's just assume here that if there was not, we would recognize the whole thing. If there was 80%, we would not. Let's see an example here. Shareholder gain or loss when contributing to a C Corp. Well, let's assume that Tom, the majority shareholder of GHI Corp, contributes a piece of land to the corporation in exchange for additional shares. Sounds similar to what we've seen. The land has a fair market value of $300,000 and a tax basis of $250,000. Now, in reality, is land going to have a different tax basis than the fair market value? Not likely, because land does not get depreciated. However, in this question, it seems like it does. That's something just to point out there. But it doesn't really matter. I mean, this could say factory or warehouse or something instead of land. So we're not focusing on that. But if any of you were wondering and you're using your brains, yeah, that's generally not what you're going to see. The basis and fair market value of land will generally be the same for the purpose of the exam. In real life, maybe there's going to be ways that it would be different. That's totally fine, but we're not getting into that. So in this case, Tom's going to receive additional shares of GHI worth $300,000. Now, before the transfer, Tom and other contributing shareholders owned 90% of GHI Corporation's voting power and outstanding shares. After the transfer, they maintain control of at least 80% of the voting members' voting power and outstanding shares, so they have 80% of that at least. So in this transaction, we meet both requirements for non-recognition of gain or loss. We have 80%, and there's no boot received here. Tom's only receiving shares of the corporation. Now, since both requirements are met, we do not recognize any gain or loss on this particular exchange. The gain of $50,000, which results of Tom receiving $300,000 of value from the shares and giving up $250,000 of basis, that's going to be deferred, and Tom will have to recognize that and pay tax on that once Tom sells the shares received in the exchange. Very good, very nice. Powering through. Hope you're doing well. I'm doing well. Let's keep going. All right, more examples, because we're going to learn by doing rather than me just talking to you. Well, I guess I still am just talking to you, but we're going to see examples here. Let's assume that Lisa, a consultant, provides strategic planning services to JKL Corporation. The agreed upon value of her services is $50,000, and in exchange for her services, JKL issues Lisa shares of its stock worth $50,000. Seems pretty fair. There we go. In this scenario, the exchange of services for stock does not count for the 80% control test. This is something we mentioned. Now we're seeing it. If other shareholders contribute property to JKL, Lisa's stock received in exchange for services will not be considered when determining whether the 80% control requirement has been met. Additionally, the value of the stock received for services rendered is actually going to be treated as taxable income as compared to if Lisa gave property. That's the rules. That's what we've been seeing time and time again. In this case, Lisa is going to need to report $50,000 as taxable income on her individual return for the shares that she received in exchange for her services. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.Examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit CPA.Examprep.ai and let's achieve your exam success together.